Hey everyone, welcome back to the channel. Ever find yourself wondering, how much should you be saving each month? Whether it's for your child's education, that dream down payment, or a comfortable retirement, we all have those long-term financial goals. But how do you actually get there? And how do you even begin to wrap your head around things like inflation? And let's be honest, who hasn't wondered? How long does it actually take to make that first crore? There are no magic shortcuts, but there are proven strategies for building real wealth. In this video, we're breaking down 12 essential investment strategies. Think of them as powerful thumb rules that can help you achieve your financial dreams. We're talking simple formulas and calculations that you can easily remember and use every day. So, grab a pen and paper because this video is packed with actionable advice you can start using today. Let's kick things off with a simple and powerful strategy, the 15-15-15 rule. Now, this rule is all about consistency and the magic of compounding. Imagine this, you invest just 15,000 rupees every month. That's it. You stay consistent with your investments, putting in 15,000 like clockwork. Let's say you are earning a solid 15% return per year, and that's achievable with the right investments. You know what happens after 15 years? You hit that coveted 1 crore mark or 10 million rupees. That's the power of the 15-15-15 rule. It's a great starting point for long-term financial goals. For instance, to save 3 crore rupees for your retirement after 15 years, assuming a 15% annual return, you'd need to invest approximately 45,000 rupees per month. However, it's crucial to remember that this is just an estimate, and actual returns may vary. Rule number 2, 15-15-30 rule. Now, if you are ready to take your wealth-building game to the next level, let's talk about the 10 crore thumb rule. This strategy follows a similar concept to the 15-15-15 rule, but with one key difference: time. We are increasing our investment horizon to 30 years. So you are still investing 15,000 rupees every month, and you are still targeting a 15% annual return. But by simply extending your time frame, you are giving your money more time to grow exponentially. And guess what? After 30 years, you are looking at a whopping 10 crores. This just goes to show that the longer you stay invested, the more you benefit from the incredible power of compounding. This one is a good one for retirement planning. Do you find this helpful? Share the knowledge with family, friends, and colleagues. And don't forget to like and subscribe for more such useful information. Next, we'll examine 4 rules for achieving 2x, 3x, 4x, or 10x growth on your investments, assuming a more conservative return. Rule number 3, the rule of 72. This rule is a quick formula that helps you estimate how long it will take for your investments to double. Here's how it works. Take the number 72 and divide it by the annual interest rate you expect to earn. The results? That's the approximate number of years it will take for your money to double. For example, let's say you've invested 10 lakh rupees and you are earning a 12% annual return. 72 divided by 12 equals 6. This means your investment will double to 20 lakh rupees in approximately 6 years. It's a quick and easy way to get a sense of the growth potential of your investments. The rule of 72 is most accurate for interest rates between 6% and 10%. For higher rates, 15% to 25%, adjusting the numerator slightly, for example using 74 or 76, gives better estimates. Despite its limitations, the rule of 72 remains a useful mental shortcut for quickly estimating investment growth without a calculator. Rule number 4, the rule of 114, tripling your wealth. We have talked about doubling your money, but what about tripling it? That's where the rule of 114 comes in handy. It works similarly to the rule of 72, but this time you divide 114 by that interest rate you expect to earn. The result is the approximate number of years it takes for your investment to triple. Let's take our previous example of a 10 lakh rupee investment earning a 12% return. 114 divided by 12 equals 9.5. So, in this it will take approximately 9.5 years for the investment to triple. Just like the Rule of 72, the Rule of 114 provides an estimate, not a precise calculation. Market fluctuations and other factors can influence your actual returns and tripling time. Useful for comparing different investment options and their potential tripling times. Rule number 5. The Rule of 144. Quadrupling your investment. Now, let's take our wealth-building goal even further with the Rule of 144. This rule helps you figure out how long it takes for your investments to quadruple. That's right, 4 times your initial investment. Just like the previous rules, you divide 144 by the annual interest rate. Using our trusty example of a 10 lakh rupees investment and a 12% return, 144 divided by 12 equals 12. This means that in approximately 12 years, your investment would have quadrupled to a staggering 40 lakh rupees. The Rule of 144 highlights the exponential power of compounding over time. This formula, too, is a simplified way to get a general sense of growth. For more precise projections, use financial calculators or consult with a financial advisor. Rule number 6. 10x in 20 years. Turning 10,000 rupees into 1 lakh rupees. This one's all about how small amounts can grow significantly over time. Imagine this. You invest a modest 10,000 rupees and let it grow for 20 years. With an annual interest rate of 12.2%, that 10,000 rupees will magically transform into 1 lakh rupees. So next time you receive a small windfall, like a tax refund or a cash reward, resist the urge to splurge, invest it, and watch it grow. The next important rule of thumb is about finding the right balance between the level of risk you're willing to take and the potential rewards you expect to receive. Rule number 7. The 100-age rule. Balancing risk and reward. As we navigate the world of investments, it's crucial to find the right balance between risk and reward. That's where the 100-age rule comes in. This rule provides a simple framework for determining how much of your portfolio should be allocated to equities or stocks and how much should be in debt like bonds or fixed deposits. The 100-age rule suggests a simple calculation. Subtract your age from 100. The resulting number represents the percentage of your portfolio that should be allocated to equities. For instance, if you are 30 years old, 100 minus 30 is equal to 70. This means 70% of your portfolio should be in equities and the remaining 30% in debt. This rule helps you adjust your risk tolerance as you age, ensuring a well-diversified and balanced portfolio. It ignores factors like income, dependence, health, and specific financial goals, which can significantly impact asset allocation decisions. The 100-age rule can be a helpful starting point, but it shouldn't be your only guide. It's essential to assess your individual circumstances, risk tolerance, and financial goals before making any investment decisions. Rule number 8. The 28-36 rule. Mastering your budget and debt. Managing your money effectively is crucial for financial success. The 28-36 rule is a simple yet effective guideline for managing your budget and keeping your debt in check. This rule states that your housing expenses, including rent or mortgage payments, should not exceed 28% of your gross monthly income. Additionally, your total debt payments, including your mortgage, car loans, credit card bills, and other loans, should not exceed 36% of your gross monthly income. By adhering to this rule, you can avoid overstretching your finances and maintain a healthy debt-to-income ratio. This is crucial for building a strong financial foundation and achieving your financial goals. While the 28-36 rule is a valuable tool, it's essential to remember its limitations. Simplified guideline. It's a general rule of thumb and doesn't account for individual circumstances, such as high cost of living areas or varying financial priorities. Doesn't include all expenses. It focuses on housing and debt, but doesn't explicitly include other expenses like food, transportation, and healthcare. Rule number 9. The Rule of 70. Understanding inflation's bite. Inflation, it's a silent wealth killer that erodes the purchasing power of your money over time. But don't worry, the Rule of 70 can help you understand its impact. This rule helps estimate how long it takes for inflation to reduce the value of your money by half. Divide 70 by the current inflation rate. The result is the approximate number of years for your money's value to halve. For example, with a 6% inflation rate, 70 divided by 6 equals 11.67. This means that roughly in 11.67 years, the value of your 10 lakh rupees will be reduced to 5 lakh rupees. Understanding the impact of inflation emphasizes the importance of investing your money to outpace its erosive effects. It's important to remember that it's an approximation. Like all other thumb rules, it provides an estimate, not an exact calculation. Inflation rates are not constant and can change over time due to various economic factors. This affects the actual time it takes for your money's value to halve. Consider real returns. When evaluating investments, it's crucial to consider the real rate of return, which is the return on your investment minus the inflation rate. This gives you a clearer picture of how much your purchasing power is actually increasing. Next, we'll cover rules for building and managing your retirement nest egg. Rule number 10. The 40x rule. Planning your retirement nest egg. Retirement might seem far away for some, but it's crucial to start planning early. The 40x rule provides a solid framework for determining how much you need to save for a comfortable retirement. This rule suggests that your retirement corpus, the total amount you've saved, should be 40 times your annual estimated expenses in retirement. For example, if you anticipate spending 12 lakh per year in retirement, your target retirement corpus should be 4.8 crores. This rule highlights the importance of consistent saving and investing to build a substantial retirement nest egg. Rule number 11. The Rule of 300. Calculating your retirement number. The Rule of 300 offers another perspective on retirement planning. This rule helps you estimate the corpus you need to generate your desired monthly income. Multiply your desired monthly retirement income by 300. The result is the approximate corpus you need to accumulate. For instance, if you aim for a monthly retirement income of 1 lakh rupees, you will need a corpus of 3 crore. Both 40x rule and the Rule of 300 implicitly assumes a typical retirement age, which is commonly between 60 and 70 years old. Both are closely linked to the concept of a sustainable withdrawal rate, often around 4%. The rules indirectly factors in a life expectancy that allows for a retirement period of around 30 years. Which one to use? Use the 40x rule if you think in annual expenses. Use the Rule of 300 if you budget monthly. Both are approximations and don't factor in taxes, market fluctuations, or personal risk tolerance. Rule number 12. The 3% withdrawal rule. Enjoying your retirement funds safely. The 3% withdrawal rule is a more conservative version of the popular 4% rule for retirement withdrawals. How the 3% rule works. Initial withdrawal. In the first year of retirement, withdraw 3% of your starting corpus. Each subsequent year, adjust your withdrawal amount to account for inflation. For example, if inflation is 6%, increase your withdrawal by 6%. So, if you withdrew 12 lakh in year 1, you withdraw 12.72 lakh, 12 lakh plus 6% of 12 lakh, in year 2. The choice between the 3% and 4% rule depends on your individual circumstances, risk tolerance, and financial goals. 4% rule offers the potential for higher returns but carries a greater risk of outliving your savings. Suitable for those with a moderate risk tolerance and a shorter anticipated retirement period. Suitable for countries with low inflation rates. 3% rule provides greater safety and reduces the risk of running out of money, but may result in lower overall returns. Suitable for those with a lower risk tolerance, a longer anticipated retirement, or concerns about future expenses. More suitable for long retirements, 35 plus years, or high inflation periods. There you have it. Master these 12 investment strategies to take control of your financial future. Building wealth takes time, discipline, and a solid understanding of financial principles. But with the right knowledge and strategies, you can achieve your financial goals and live life on your own terms. If you want to know how to make small changes in your habits for big financial benefits, see this video. Until next time, happy investing!